If you're following global finance, you've probably felt that dizzying sensation looking at the gold market lately. We are not talking about small incremental movements anymore.
Not at all.
In the third quarter of 2025, the London Bullion Market Association price for gold averaged a staggering $3,456 per ounce.
That is a truly remarkable 40% year-over-year increase. It,
Yeah.
it just defies decades of conventional market logic.
Right. It's behaving parabolically. And if you approach it with the traditional playbook of, supply, demand, interest rate correlation.
Nothing makes sense. The old market rules, the very drivers we all used to track daily, have been completely upended.
And that's exactly why we're here. Our mission today is a deep dive into the research from powerhouses like Societe Generale, the World Gold Council, and Deutsche Bank. We need to unpack why gold is soaring and, critically, what this tells you about global economic stability.
And the core thesis the sources reveal, and this is the fundamental part to understand, is simple. The inelastic demand coming from official state actors, the central banks, has now completely eclipsed the traditional price-sensitive drivers.
So it's a structural reengineering of how gold is priced.
Exactly. We're witnessing a structural reengineering.
Okay, so we have to start by accepting that the old leaders are, well, failing to lead. Let's look at the drivers that gold used to respond to, because they are clearly not responsible for a 40% price move.
We absolutely must set aside those traditional fundamentals. I mean, they still exist, of course, but they are fading and shading rapidly in importance as price setters.
The classic demand sector is, naturally, jewelry. Historically, if the gold price spiked, the price elasticity of jewelry demand meant people just stopped buying, right? It acted as a natural market stabilizer.
Exactly. Jewelry displays negative price elasticity, typically around negative 0.4. Higher prices mean lower volumes demanded by consumers, especially in Asia.
And the data still shows that.
It does. The Q3 2025 data confirms the standard behavior is still in place. Consumption volume dropped 19% year-over-year, falling to 371 tons. That drop aligns perfectly with Sajjan's models, which predicted a 20 to 23% volume reduction.
Okay, so the consumer is behaving predictably. But here is the critical twist. The total value of jewelry consumption actually rose 13% to $41 billion.
And that value increase confirms two things for us. One, there isn't some unusual collapse in the underlying retail market. And two, the jewelry sector is suffering volume pain precisely because the price is so high.
Which means?
It means it is definitely not the entity driving the price spike. It's just being pulled along by a force it can't control.
And if jewelry isn't moving the needle, what about the big institutional money? I mean, we're talking about exchange-traded funds, Western money in Europe and North America that used to dictate market direction.
Yes. The sources suggest a significant reversal there, too. This reversal dynamic is, I think, one of the most intellectually compelling shifts. Sajjan deployed what are called Granger causality tests.
Okay, let's pause on that jargon for a moment. For those of us not in quantitative finance, what exactly does a Granger causality test tell us? Why is it important here?
It's a statistical tool, essentially. When we look at two financial time series, in this case ETF flows and gold prices, the test determines if changes in one variable can reliably predict future changes in the other.
And historically, the finding was clear. Big ETF flows would predict the direction of the gold price.
That's right. But now
it's flipped.
it's completely reversed. Now, the tests show that gold prices precede ETF flows. This means that where institutional funds once led the market, they are now reacting to momentum that has been set elsewhere.
So they're followers, not leaders. They're just scrambling to catch up after the price has already moved.
Precisely. And the numbers back that up. Global ETF elasticity is hovering near zero. So while Q3 2025 saw this massive 134% surge in inflows, about 222 tons, that surge was purely an institutional reaction to price momentum already baked in.
What about Chinese ETFs?
Well, we should note that Chinese ETFs show their own volatility, but that's generally linked more to the unique domestic gold market integration and, local speculation. It's not really providing global price direction. The takeaway here is absolute. The old leaders are either adhering to old dampening price rules, or they are simply reacting to a force they didn't create.
So if traditional investors and price-sensitive shoppers are just reacting to high prices, we have to pivot to the new engine. Who is the entity that has the scale, the strategic imperative, and maybe most importantly, doesn't care what the dollar price is?
The central banks. We are seeing a historic, absolutely relentless accumulation spree from the official sector. This isn't just an uptick.
It's a paradigm shift.
It really is.
So give us the hard numbers on this accumulation.
In Q3 2025 alone, central banks net purchased 220 tons. That's a 28% increase quarter over quarter. It brings the year-to-date total to an astonishing 634 tons.
Wow.
And this buying is consistent. Even August, which is historically a slower month for sovereign purchases, saw an increase of 19 tons.
That is an immense rate of accumulation, and it's the key structural change. So Zirgan data pegs the elasticity of this official demand at nearly 0.9 from 2023 to 2025. That's virtually perfectly inelastic.
And this is where the why gets incredibly interesting. Because that high elasticity doesn't mean they're chasing the price. It means they are utterly insensitive to the price.
But historically, central banks have been, let's say, notoriously unreliable buyers. They often step back when prices soared. What makes this spree different, according to Deutsche Bank's analysis?
It all comes down to their strategic objective. Deutsche Bank clearly defines the concept of inelastic demand here. These institutions are not working off traditional, finite, price-sensitive annual budgets where the CFO says, we'll spend $5 billion on gold this year, so if the price rises, we buy less.
They're targeting tonnage goals, not dollar value constraints.
Precisely. They are aiming for specific reserve resilience targets. If they determine that reserve stability requires, say, 50 more tons of gold, they will acquire 50 more tons of gold.
Regardless of whether the dollar cost is $3,000 or $4,000 per ounce.
Exactly. And the sources clarify how they achieve this price insensitivity. If a sovereign institution is determined to hit a tonnage target, they are structurally capable of ignoring the cost in their own local currency.
That's the crux of it.
It is. Deutsche Bank notes that central banks have the ability to create domestic currency or monetize reserves as needed to acquire the metal. Their purchases are linked directly to strategic goals, repatriation efforts, and expanding domestic vaulting capabilities. They view this as a hedge against geopolitical risks.
Like reserve freezes and future sanctions.
That's it. So this is less about generating profit and much more about national risk mitigation. It's a defense strategy for their reserves, making gold a geopolitical asset, not just a financial one.
And the data shows who is leading this. It's overwhelmingly the emerging markets.
Absolutely dominating the purchases. The top list includes China, Poland, India, Turkey, and Kazakhstan. This is not a Western trend. It's a diversification movement centered in the global south.
And the intent to continue is robust.
Completely. The WGC survey backs this up. It found that a staggering 95% of central bank respondents anticipate global reserve expansion. Even more significantly, 43% of central banks specifically plan further increases.
And they have a target in mind.
They do. They are aiming for gold to comprise about 22% of their total reserves. That 22% target signals a profound long-term shift away from reliance on foreign-held and potentially vulnerable assets.
That is a fascinating metric. Okay, moving on, we have to talk about the groups that amplified the central bank rally. Because not everyone is reacting negatively to the price, like the jewelry sector.
That would be the bars and coins segment. While the high street consumer pulls back, the retail investor buying physical bars and coins displays the complete opposite of jewelry. Positive elasticity, around 0.4.
Meaning, the higher the price goes, the more confidence they gain. They think the rally must continue, and they pile in.
It becomes a momentum multiplier. In Q3 2025, 316 tons of bars and coins were demanded, a 17% jump year over year. This pushed total investment demand to a record 537 tons. This segment ensures that once the central banks set the upward trend,
The retail investors amplify the velocity of the move.
yes, preventing any kind of smooth stabilization.
So we have inelastic sovereign demand setting the floor and direction, and momentum-driven retail investors piling on top. But this rush for physical metal is running headfirst into structural constraints on the supply side.
It is a fundamental conflict. Global supply only rose a modest 3% in Q3 2025, totaling 1,313 tons. The lion's share came from mine production, 977 tons, which is inherently slow to grow. It takes years and, well, billions to bring a new mine online.
And high-grade discoveries are getting scarcer.
They really are. This supply constraint is vital when we discuss how prices are being set. Analysts are now calling this situation the death of synthetic gold.
That sounds dramatic. What does that mean for how you, the average investor, should perceive price discovery?
It's a hugely important concept. For years, the gold price was primarily set by the paper markets, futures contracts, derivatives, institutional ETFs, the so-called synthetic gold. This paper volume massively overshadowed the physical tons actually changing hands.
So if there was a sudden sell-off in a major futures market, the paper price would fall and the physical price would follow.
Right. But the death of synthetic gold means that the overwhelming volume of physical tons being removed and vaulted by central banks and strategic investors is now eclipsing the influence of those Western paper instruments.
Physical demand is driving the paper price, not the other way around.
Exactly. And this shift must introduce massive risk. If emerging markets continue their planned rebalancing to hit that 22% reserve target, that colossal price inelastic physical demand is going to smash right into a rigid, constrained output wall.
That is the structural pressure point for the next few years, which I think brings us logically to the bigger picture, the context of the evolving global monetary system, because this demand isn't random.
No, not at all. This entire gold surge is a direct response to the decline in geopolitical trust and the weakening of the post-1970s dollar order. The pillars that have upheld dollar dominance for 50 years are under significant pressure.
We're talking about three specific pillars.
Right. First, global reliance on the U.S. Treasury market for safety and liquidity. Second, the dollar's sheer dominance in global trade and payments. And third, the reliable availability of dollar funding liquidity.
And all three are showing signs of fracturing. We're seeing diversification in payments, surging Treasury issuance due to ballooning U.S. deficits. But the most acute trigger, you have to think, is political risk.
Oh, the specific threats are not theoretical. Events like the freezing of foreign-held reserves in recent geopolitical conflicts that served as a giant flashing neon sign to central banks worldwide.
Saying your foreign assets are political vulnerabilities.
And they can be weaponized. That realization instantly translates to reserve reallocation towards assets held domestically and free from external legal jurisdiction like gold.
And when you compare the official rhetoric, the fracture in global thinking is obvious.
Absolutely. Western officials, including those at the Federal Reserve, they often maintain the narrative that the dollar is unassailable. They frame gold accumulation as a minor, volatile price signal.
But their European and, crucially, emerging market counterparts are explicitly acknowledging the erosion of trust in the dollar in their internal policy discussions. They are acting on the recognition that the monetary order is fundamentally shifting.
That difference in perspective is vital for you to grasp. The sustained buying, despite historically high prices, is driven by a strategic fear, not a speculative profit motive. When we look at the summary data, Q3 total demand, hitting a record 313 tons, valued at $146 billion, that entire propulsion was generated by strategic forces ignoring price.
So what does this all mean for you, the person trying to navigate this new gold reality? We have four demand ecosystems colliding, but the central banks are now positioned as the pivotal marginal force. They're overriding the natural stabilizers in the system.
Right. We have the price-sensitive group jewelry, which pulls back volume. We have the momentum-driven group bars and coins, which pushes volume forward. We have the reactive group ETFs, which only follows. But the massive price inelastic official buying is the force that dictates the floor and provides unstoppable momentum.
And the WGC and Deutsche Bank data confirm that these sustained elevated purchases are continuing, even as the price skyrockets. This indicates that this is not a cyclical bubble to be popped by a rate hike.
No, this is a clear, long-term structural shift in global reserve strategy. And this leaves the most provocative thought to consider moving forward.
Go on.
If central banks have become the marginal buyer and they are effectively setting the gold price by creating domestic currency, unconstrained by price, to hit specific reserve tonnage targets, what does this ultimately imply for the stability and traditional reserve role of the dollar in future global reserve planning?
The buyer of last resort is no longer interested in the old price rules.
And that changes everything.